Hello everyone, Derek Smith from ComprehensiveCreditRepair.com, and today I want to talk about how credit utilization affects your credit score in today's credit repair tip. So let's go ahead and get started. Your credit score is one of the most important numbers in your life. It affects whether or not you're approved for a loan or whether or not you can get a credit card. It also determines how much interest you'll pay when you need to borrow money for anything from a house to a car. Plus, if you're renting, landlords and even employers often access your credit report to determine how reliable of a tenant or employee you might be. Needless to say, keeping that score as high as possible is a big deal. Your credit score can range anywhere between 300 and 850. Anything higher than 700 is considered good, while the bad credit range is anything under 600. There are 5 different categories of information utilized to calculate your credit scores, each one with a different ranking of importance. Here's how each category of your credit affects your score. First is payment history. How frequently you pay your bills on time accounts for 35% of your credit score. Credit utilization. The amount of debt you owe to creditors and lenders make up 30% of your credit score. Length of credit history. How long you've had access to credit is worth 15% of your score. Credit mix and inquiries. The diversity of the types of credit you have and the number of inquiries you've had in the last 2 years each account for 10% of your credit score. So as you can see, the amount of debt you carry or your credit utilization is the second most important component of credit scoring. It's the amount of money you borrowed through both loans and credit cards and compares it to your actual credit limits. It takes into account how much debt you still owe, how many actual accounts have money owed on them, how much you owe on each one of those accounts, their percentage of revolving credit lines, the percentage of installment loan debt, and potentially the lack of certain kinds of loans. All of these items combine to contribute nearly 1/3 of your credit score. So if you want to improve your credit, you're going to have to pay attention to your credit utilization. Let me talk about how credit utilization is calculated. The most important factor when considering your credit mix is how much debt you have on revolving accounts compared to the maximum amount you're allowed to charge. Now, this is referred to as your credit utilization ratio, also referred to as your balance to limit ratio or your debt to credit ratio. It's a very simple calculation for you to figure out. First, start by tallying up all your debts. Then separately tabulate all of your credit limits. Then take that and divide the amount of debt by the total credit limits, and you have your credit utilization ratio. So if you have 2 credit cards with a combined limit of $5,000 and you owe $1,000, your calculation will be 1,000 divided by 5,000. You get a 0.20, which means your ratio in this scenario is 20%. It's calculated using all of your debts spread out across all your spending limits. So when you pay off one credit card, should you automatically close the account? Well, the answer to that is no. This actually can hurt your credit very quickly because taking away an entire line of credit is going to actually increase your ratio, the exact opposite of what you want to do. So here's how that happens. Let's go back to that example I gave you where you owe $1,000 and have $5,000 in total credit card limits. Say each card has a limit of $2,500, but you have a credit card balance of $1,000 on just one card. So if you close the balance free card, your total credit limit drops to $2,500. Instead of having a 20% credit utilization ratio, the new calculation shows that your ratio has instead jumped up to 40%. That's double your initial score. Once that happens, your credit score will inevitably drop. So let's talk about revolving debt versus installment debt. When talking about how to utilize credit, it's important to understand the different types of debt you might have on your credit report. Revolving debt like credit cards and store cards are weighed more negatively than installment loans such as mortgages, student loans, and auto loans. There are a few different reasons that this happens. One is that installment loans like those on your house and car have collateral attached to them, so they have that backing it up. If you stop making payments, the lender can foreclose on a home or repossess the car. That makes people more likely to repay those loans before any other type of debt. It also helps the lender recoup the loss of the loan payments should you stop paying. Student loans don't have collateral, but they do indicate to lenders that as a borrower, you might have a higher capacity for earning potential over time. Revolving debt from credit cards, on the other hand, has no collateral attached to it at all. Lenders believe that you'd be less likely to pay on it if you came into financial hardship because you have nothing to lose except your good credit score. Now, some installment loans like mortgages and student loans are typically viewed as being good debt because they can add value to your income and your net worth. So when your credit score is calculated, it takes into account not just how much debt you have, but what kind of debt you have also. This knowledge can help you focus your goals if and when you decide to aggressively pay off your debts. Now, it's best to start off with anything owed on a credit card or retail card because they typically carry higher interest rates. They also are weighted more heavily when your credit utilization is calculated for your credit score. Let's talk about how you can get the best credit score that you can. So now you have the information you need to figure out your credit utilization ratio. How does it look overall? Now, most financial experts recommend owing no more than 30% of your credit limit. I say 25%. So if your credit card maximums total $5,000, you wouldn't want to owe more than $1,500. Of course, if you pay off your balance in full each month, it's fine to charge that amount. However, understand that when you're applying for a loan or credit card, it may very well show your average balance even if you pay it off regularly. To get around this technicality, you can do one of two things. Either stop using your credit cards for at least a month before submitting a financial application, or pay on your account multiple times a month so the balance never looks too high. That's especially helpful if you rely on any of your cards for some type of rewards program. Another option you have is getting a balance transfer card to transfer balances to a new credit card with a higher credit limit. If you do regularly carry a balance on your credit cards and it's around or above 30% of your overall credit limit, there are still some things you can do to help boost your credit. Now, the most obvious one is, of course, to pay off your debt as aggressively as possible. This is going to increase your score in a variety of categories, but especially in the amounts owed category. Remember the subcategories of credit utilization. Not only does your credit score consider the overall ratio of your credit spending, it also factors in each individual line of credit. So if you've maxed out one card and don't have much charge on the other cards, focus on getting a high balance card paid down first. There are many other strategies for how to pay down credit card debt, but this is the best one for getting your credit card or your credit score to increase as quickly as possible. You could also consider opening new lines of credit. So another trick of the trade to lower your credit utilization score without actually paying down extra debt is to open up a new line of credit. By adding a new credit card, you'll automatically have a higher overall limit. Of course, each inquiry for a new credit card or loan application has the potential to temporarily lower your score between 5 and 10 points. So be careful how often you do this. If you already have a lot of inquiries on your credit report, this may not be looked on favorably by lenders. But if you haven't had any hard inquiries in the last 2 years, getting another credit card to use responsibly or not at all could alter your credit score in the right direction. One last red flag lenders look for on a credit report is when you have too many balances spread out across several cards. Yes, that individual credit utilization limit looks lower, but the fact that you're constantly charging multiple cards can be worrying to an underwriter reviewing your loan or credit card application. Another strategy to address this issue is to pay down the smallest card first so that you clear an entire line of credit quickly. Figuring out your credit utilization ratio may seem daunting at first, but no matter what the technicalities may be, simply paying down your credit debt is often the best way to improve your credit. So thank you, everybody. This is Derek Smith from Comprehensive Credit Repair. And if you ever need someone to help you, a pro to help you get your credit score in order, please reach out to me at comprehensivecreditrepair.com, and I will be happy to give you a free analysis and to answer all your questions. I'll see you in the next video.